Greetings and welcome. I am Professor Denver, and thanks for checking my presentation on basic accounting in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners. This session is about concepts presented in Chapter 6 regarding year-end adjusting entries, post-adjustment trial balance, closing entries including the income summary account, and net income. At the end of an operating period or accounting cycle, accountants make adjusting journal entries for unrecorded revenue and expenses to determine the true operating results for the period. This is necessary because payment for some resources used by the firm might not have been made or paid in advance or transferred from unearned revenues to recognize actual revenues earned and need to be recorded to determine the true profit or loss for the period. Examples of such adjustments include transfer of amounts used up during the period from payments made in advance for insurance and rent, called prepayments, technically prepaid assets, accruals, unpaid wages and salaries of employees, depreciation expenses, estimates for bad debts, interest accrued on long-term debts, transfers from unearned revenue to earned revenue for the period, and inventory adjustments and the cost of sales. After the adjusting entries are completed and posted to the general ledger, a post-adjustment trial balance is prepared and the debit and credit columns totaled to check that they are equal in accordance with the double entry accounting concept discussed earlier. A review of the post-adjustment chart of accounts and trial balance shows the totals of the debit and credit columns are equal, also referred to as footing the trial balance. After the accountant has reviewed the trial balance and is satisfied that it is in order, he or she proceeds to the next phase of the systematic steps in closing the books. Closing the books refers to closing out all the nominal or temporary revenue and expense general ledger accounts by transferring their balances to another temporary transitory account, the income summary account, which is then closed out to the retained earnings account. The income summary or general ledger account, as its name implies, summarizes the net income or loss in an accounting cycle as a temporary clearing account and is not a typical general ledger account. It is used as a temporary holding account for balances transferred from the revenue and expenses general ledger to zero them out and determine the net profit or loss for the period. The income summary account is only used with the end of period closing entries to determine the net income or loss for the accounting period. The end of period closing entries, or closing the books, refer to closing out all the nominal or temporary revenue and expense accounts at the end of an accounting cycle by transferring their balances to another temporary account, the income summary account, which in turn is then closed out to the retained earnings account shown in the equity section of the balance sheet. A general journal is used to record the closing entries required to clear the balances in the revenue and expense general ledger accounts at the end of the accounting cycle. The revenue general ledger account balances are closed by debiting each account, totaling their amounts, and crediting the income summary account with the total. The expense general ledger account balances are closed by crediting each of these accounts, totaling the amounts, and debiting the income summary account with the total. If the total revenue amounts are larger than the total expense amounts that are close to the income summary account, the income summary account will have a net credit balance or net income, which is then closed out to the retained earnings account by debiting the income summary account and crediting the retained earnings account with a balance. However, if the total expense amounts are larger than the total revenue amounts that were transferred to the income summary account, the income summary account will have a net debit balance or net loss, and the account will then be closed by crediting the income summary account and debiting the retained earnings account. Upon posting the closing entries to the general ledger, all the revenue accounts, expense accounts, and the income summary account will have zero balances, as the net income or loss would have been transferred to the retained earnings account for the period. A net income or loss is shown at the bottom of the firm's income statement for the period. It is the net difference between the total revenue amounts and the total expenses for the period, and the net income or loss is added to the retained earnings account shown on the balance sheet. Remember that the balance sheet and the income statement are two of the end of the year financial reports required for each firm. That is all for now. Thanks for watching this presentation. Have a great day.